All right, hello everyone. This is Jeffrey Cohen, Chicago Quantum, here to talk to you on week 36 of 2021. I want to thank you for watching. You are awesome. Appreciate your attention. We're going to talk about the stock market. We're going to talk about our startup firm. We're going to talk about biotech. We're going to really drive this business forward with you. And my goal is that you learn and prosper from watching this and from follow-up activities. So let's get started. And I got my notes over to the left-hand side here. Oh, over that side. So you can follow along too. So first off, it's a short trading week, right? And we found biotech to be down. Biotech is risk off. So most biotech investments have no earnings, cash drain, no products. And you're just hoping for something big like scientific discovery, the FDA to approve a new drug, maybe a buyout. And so, but what normally companies move up and down on is, consistent earnings, good sales. And so we're long in three small biotechs that are very much affected by risk on or risk off attitudes. And so I just want to tell you, right, there's a lot of cash out in the market, and we're going to talk a little bit about that. A lot of cash. There's a lot of reserves. There's a lot of money. The Federal Reserve, our federal government, has bought $4 trillion worth of debt and put it on the balance sheet. Well, what did it use to pay for the $4 trillion of debt? Money. And that money is in the banks. It's in the financial institutions. It's there. So when I look at the market today, I see it in the context of the Battle of the Alamo. So, folks, do you remember the Alamo? Well, I do, right? It was a standoff. It was a small group against a large group. It was a fortified building, stone building, right? I've been to the Alamo. Peewee Herman's been to the Alamo. And let's talk about it. So, this world of biotech, right? There's a lot of new stocks out there, a lot of IPOs. Every time we run our model, you got another 1% new stocks, like almost every week. It's crazy. I want to say there's 4,800 stocks right now listed in the 5 stock exchanges we run. And that number was like 4,200 when we started. There's a lot of new companies, a lot of IPOs, a lot of places to invest your money. There's debt. There's a tremendous amount of debt that's been issued. There's government securities. It's crazy. I want to say we owe like $28 trillion. Well, we just sold $120 billion of new securities this week. It's a lot of places to put your money. I mean, all 3 of our biotechs trade, the whole stock is under $1 billion cumulative. So it's 120 of those. I mean, so there's a lot of pull for cash, right? Pull. Places to invest. There's Bitcoin. There's cryptocurrencies. There's metals. There's all kinds of stuff. Now, and cryptocurrencies are new as well. They're a new drain on capital, on cash in our system. So it's a bit of a battle, and I'm not sure which way it's going to go. It's in the heat of the battle. So now what? Ammunition, right? When you're looking at a war, always look at the arms dealers. And so the big arms dealers in our world are the U.S. Treasury Department and the U.S. Federal Reserve Bank. So they've got some big choices to make. And so, I mean, of course, that we're approaching a debt ceiling, a U.S. federal debt limit. And it was actually waived before COVID, and then it was any COVID borrowing didn't affect it. And so now we're basically at the cap again. So what do? You either raise the ceiling, it's fine. And by the way, the federal government politically, from a fiscal perspective, is looking at spending a lot more money. So they're going to have to raise that debt, right? You could spend less, always a possibility. I got to tell you, right, my wallet, it's a little thin these days. And so when it's thin, I actually leave my credit card at home. I don't spend, right? I got prayer beads. They're old. I don't need new ones. I just use what I got, right? And the government can do the same thing. In fact, we could spend a lot less. The other thing we could do is we could raise taxes. And we could just right away raise taxes, right? So, you don't want to borrow anymore. Just raise all the taxes. So you can either spend less or you can tax more if you want to deal with this debt ceiling. But my guess is that they're not going to do either of those. They're going to continue to spend more and tax the same, and we're just going to have to borrow more. I don't know. I mean, it just doesn't make sense. Again, it's a battle of the Alamo here, right? Which way is it going to go? And so, there were some questions, right? I have some data on this. There were some questions about what's the Federal Reserve doing? Like, what's going on, right? And so, I got some pictures, pretty pictures here. I'm going to flash them up on the screen for you. First off, for those who like Peewee Herman, this is a picture of him outside the Alamo as it is today. I want to say it was Pee-wee's Excellent Adventure. Love it. Made a lot of pictures this week. Just want to show you how bad it was in biotech. Earlier this week we took this picture. So it's a heat map. So the size of the rectangle is the market capitalization, and the color is how it did this day. Okay? And this was run on September 8th. Wednesday. So on Wednesday, pretty much every biotech was down. Every drug manufacturer was down for the most part. Some were down a lot, almost 3%. Some were down only 0.5%. It's fine. Biotech was down. You have to go all the way to TECH, which is the 10th largest biotech to even have a positive. And then 2 out of 15, and then it just gets worse from there because you have another like 20 of them that are red. So maybe it was 3 out of 50 were up. And so it's a tough market. So why is healthcare suffering so much? We're in the middle of a COVID pandemic. You would think the drug companies are who we're looking to save us. But that's not the case. In fact, that's not the case for real. August 12, President Biden, President of the United States, Joe Biden, came out and said that we are going to hold down drug prices. We are going to stop their exorbitant profits, and we are going to compete. We are going to negotiate with Medicare, and we're going to drive down, and then we're going to give the savings to the private sector. So guess what? I don't know about you, but if I'm a vice president or a senior vice president at Novartis or Eli Lilly, let's say I'm at Eli Lilly and I'm in Indianapolis, or I'm at Merck and I'm in New Jersey, right? And my congressman or congresswoman comes to me, or my senator comes to me and says, look, I need you to kind of take it easy a little. I need you to lower your drug prices 10%. Look, I got constituents, they're on my ass, I need you to lower the drug prices. And if you don't, I'm going to send Biden's Medicare, Medicaid people at you, and they're going to cut you 25%. So there's no upside for Merck, or for an Eli Lilly. The only upside is to hurry up and invent some new drugs where there isn't a choice, and you can charge what the market will bear. Well, guess what? It's really hard to invent a new drug, especially when the FDA has had turnover, has had issues with drug approvals. They're focused on COVID and trying to force down the whole vaccine thing. They're not focused on, maybe other medicines getting approved. I'm just not seeing a lot of activism at the FDA. So, I got an FDA with issues. I got a president of the United States who wants to squeeze the profits. And then what is biotech anyway? Biotech is a bet on the future. That I'm going to be able to make a profit on these drugs to pay for all the losses, for all the heartache. I mean, I got one stock, Corbis, they just keep missing their endpoints over and over again. And yet we still invest in the company because we believe that they can do it. Well, if they do it, don't turn around and say they can't make a profit. Because to be honest, why would I ever invest in that type of company? I want them to charge a lot. You're curing cancer in 1 million people. I want you to charge a lot of money. I want you to save lives, but I want you to charge money. And then I want you to pay back the shareholders that for all those years invested in your business. So please, the French did this early on. I want to say it was in the 70s or 80s when Ciba Geigy and all these companies were French. Remember that? Well, they did an excise profit tax. And they destroyed the French pharma industry. Please, if you're listening, don't do it here. Don't do it here, especially when we're investing in these companies for the future. Whether it's COVID or whether it's any kind of disease or virus or infection, let them make a few bucks, right? Let them make a profit. And by the way, the market will decide when it's too much of a profit because there's only so much money to go around to spend on healthcare. And let's be honest, if you were to look at this chart and see Amazon's market cap, I believe, is more than the entire healthcare and biotech industry combined. So people have plenty of money to buy bags of nuts on Amazon, or plastic flowers, or electronics. So let's see what else I got from Amazon. Oh yeah, weightlifting gloves from Amazon. But they won't spend to save a life? Come on now. Someone's playing games here. So let's keep going. I cannot answer that phone. I'm sorry. So what else we got here? I got some other data. Oh, here's another thing our federal government's going to do this week. Whoever's calling me, I'm so sorry, but I can't answer. If you want to talk, get onto YouTube, get into my video, and ask me a question, right? AMA, ask me anything. Just do it. I love it. I'm looking for people to chat me up. So here's the other thing that the White House has said that they're going to do. I love this too because this reminds me of a joke, okay? It's a joke. It's not going to really happen. But, you know, the church wants you to have fish on Fridays. Well, obesity is a big problem in American healthcare. If you want to cut the cost of healthcare, you got to get people to get thinner and more fit and take care of their bodies. And so there was a saying, well, if the government can tell you that you can't smoke, you can't drink, you shouldn't drink, you can't smoke pot, then they can tell you what you can eat. Well, in this case now, meat prices have gone up in the store. It's true, I'm probably paying 50 cents to $1 more for a pound of meat. Now, it could be because of COVID, there's fewer cowboys and cowgirls out there, right? It also could be that we're buying more meat. It could be that there's less meat, that they had to kill off some of the herd because maybe there's less food to feed them, right? So that it's a cycle, right? It takes time to grow new animals to eat. So the White House has said they are going to strengthen the regulations on meat. We're going to avoid price gouging. We're going to lower the price of meat. Okay, well, why don't you go to my grocery store, Jewel or Carcinera Jimenez, and ask those guys at Carcinera Jimenez. By the way, they sell the very thin meat because people can't afford to buy a whole steak that shop there. So they're selling to a very money-tight crowd. I like to go there because their fruits and vegetables are amazing. This is in Wheeling, by the way, if you ever get out there. But I like the meat. Good quality, very thin cut, so that you can buy like a quarter pound, feed a family, right? So they're also going to get people to expand processing capacity. How are you going to do that? You tried to do that with semiconductor chips. It's just not really happening. So what? We're going to open up more pig farms. Maybe we could mandate one more pig farm in every county, one more cow in every barn, and one more chicken in every coop. I don't know. Or maybe it's the middle processing part. We're going to add machinery to the meat packing facilities. Honestly, my guess is that meat packing, people are pretty close. It's cold, but people can be pretty close together. There's probably COVID issues. The last is they're going to promote American-made labels. Now, truthfully, I don't care where the label is made, as long as the meat's fresh, right? If you want to make the little sticker, you want to make it in China, that's fine with me. Now, most of my meat, I believe, comes from America because it would spoil on a boat. That's just me. I don't know, but I have no idea how the White House thinks it's their business to get involved in meat prices. It's not. Stay out of the meat packing industry. Okay? What else are they into? Got some COVID stuff that I just don't think you care about. Here we go. Now we're going to start talking, right? So, Jeffrey, I had a question this week. Jeffrey, tell me about how much money that's been created in the system. And I want you to compare that to the money that's gone into stocks. I can't quite do that free-spirited right now, but I am going to do it a little bit, right? I'm going to give you a sense of where we're at, right? So this is the depository institution reserve. So think of it this way. I'm U.S. Bank. Okay, I'm not the biggest bank, but I'm a bank, and I'm conservative, right? I'm not going to make bad loans. I'm not going to take a risk with my investors' money. So what I do is I have plenty of reserves to cover my deposits, my loans, my credit cards, everything, right? I'm good. My commercial loans. So it looks like in January of 2020, we were about $1.7 trillion in reserves. And then after the pandemic hit, we were at 3.2 trillion. So we doubled reserves, 1.6 trillion. And now we're at 3.9. 3.9 trillion. I want you to think about that number for a minute. Banks, some insurance companies, right? Whoever has an account with the Fed has 3.9 trillion dollars, 3.9 and a half. Oh, I forgot a half a trillion dollars on deposit, right? So go from 1.7 to 3.9. That's 2.2 trillion. Write that down. 2.2 trillion we created in reserves in our system. Okay, at least we know the banks are healthy. That's nice. 2.2 trillion in reserves. Let's take a look at the money stock. From about when this thing was a nightmare, right here, right before the COVID, looks like we were right about maybe 15 trillion in money. And now we're at 20.5. So we've created 5.5 trillion of money. How do you do that? I don't think the printing presses run that fast. I haven't seen a lot of hundreds. Actually, I haven't seen very many hundreds at all since COVID started. But let's assume you ran the printing press full speed. You're not printing $5.5 trillion of money. So what you did is you took those reserves and you turned them into money. Okay? Reserves, somehow, boom, money. But you also created some more money because 2.2 isn't enough to create 5.5 in cash, in money. So M2 is coins, paper, it's short-term deposits, it's checking accounts, it's savings accounts, and it's short and smaller CDs. Liquid, okay? 5.5 since this whole thing started. So, okay, I got it. So remember, 5.5, we created money. 2.2 got parked in reserves. This one I love. This one I love because I don't know. This is one where I want you to really think for a minute. Okay? These are the assets that the Federal Reserve Bank holds. Think of it like in a vault. Okay? So they bought with cash $8.35 trillion of assets. Now, these are not assets like a coin collection or stamps or baseball cards. These are debt securities. So these are securities that pay interest. So here's the good news. At least the Federal Reserve is getting paid interest on $8.5 trillion. So, I used to worry, right? Oh, our debt, we're not going to be able to roll it over, right? We're held hostage. Well, not when you own your own debt. $8.5 trillion of it. Now, it's not all of it, but it's a lot, right? Now, how much did this go up? So before the COVID, we were at about looks like about 4.2. So we bought 4.15, let's call it round up, $4.2 trillion of debt. And this was mortgage-backed securities as well as federal agency debt as well as federal debt. So think Ginnie Mae, Fannie Mae, Freddie Mac. I want you to think Wells Fargo had a couple of collateralized mortgage obligations. The Fed probably took that too, as well as your 10-year treasuries, your 2 years, your notes, your bonds, probably your bills as well. So it's 4.15 trillion. So I took in the debt, I gave you money. So this is where most of the 5.5 trillion came from, is 4.15 trillion that I took assets and I gave you cash. And by the way, I'm not giving the cash anymore, any interest payments, I keep those. So it's not just the 4.2, but it's the interest on the 4.2. So now I got a lot. So what am I going to do? So we have a debt ceiling. We got $8.5 trillion of debt. We can just let this stuff mature. I love it. Do nothing. In fact, you could take the interest that you're paid every month and you use it to just buy back a little more, and then start maturing it away. Now what's going to happen is you're putting even more cash in the system. So $5.5 trillion in cash. Where's it going? We're getting to your answer, buddy. Don't worry. So the first thing you look at, though, I just want to make sure that we don't have inflationary issues, right? So, I haven't read much about inflation lately. In fact, other than in China, where they say that there's inflation at the factory gate, not seeing it in America as much. Although I saw it in meat prices. I do see it at the pump. Energy prices. Groceries are more expensive. We spent like $200 this week on groceries. It's crazy. So, but the velocity of money normally is around a 2. I get $1, it doubles. It spins around, it gets spent twice in a year. Okay? Our dollars aren't getting spent very fast. So the velocity of money is at pretty much historic all-time lows. So money isn't moving. There's so much money that it's sitting in the reserves. I want you to think about that. There's nothing to do with it. There's nowhere to invest it. There's not enough biotechs that are like interesting for people. So the money's just sitting. And overnight they repo it. So they park money in the federal government overnight for 5 basis points, for 0.05% interest per year. What are you doing? When did money ever become so unpopular? Right? But it is. It just sits in M2, and it doesn't get spent, and it doesn't get loaned out. In fact, I have another chart here I'm going to get up to, which is on capital, which is on borrowing. Oh, here it is. This is always interesting. No, this is different. Here we go. Commercial paper. So I was trying to figure out, it's hard to find a metric for all debt, but I could find a metric for short-term debt. Commercial paper is corporate borrowings, including banks to some extent if they don't want to go to the federal window, the discount window, right? Or bank to bank. So this is just commercial paper. So it's less than 9 months in duration, big dollar amount denominations. So it's not like you and I are going to lend money to General Motors at $100, but $50,000, $100,000, $500,000, you might lend them money for 30 days, 90 days. And so when you look at this, we were at $1 trillion. We were actually at about 1.2 trillion before the COVID, maybe 115. And we look like we're right at about 116. So commercial paper, right? Companies don't need your money. Companies aren't borrowing. This is why there's talk about maybe buying back stock or whatever, right? Because the companies don't need to borrow more. Companies are flat. Like, this is interesting. I never looked at this before. So if companies aren't borrowing the money, this is why the money's just sitting out there. I used to say the banks are stupid, right? They should hire bankers and they should lend the money. But that's not the case. No one wants to borrow it. They borrowed the same amount they did before COVID as now. Now this is where it gets interesting, because this is an index of the total value. Total bond. It's not though. This is an index. I'm going to forget this one. It doesn't fit with my story. Talked about commercial paper. Yeah, here's the other thing I want to talk about. So you would think with all this money sloshing around, right? We'd be worried. Oh, there's a bubble. Oh, stock prices are so high, there's going to be a crash. I mean, I hear this. I hear my father's God rest his soul. My father died. But he always worried about the next Great Depression. And he was worried that the stocks would crash, right? Well, if you look at the stock market fear index, so before the COVID, we were running about a 10 to 20 VIX pretty consistently. And sometimes he got down to about 10. If you look at 2017, then the COVID hit, the VIX went up 80, 90%, 80 to 90 points basically. And that's terrible. That's your insurance that you'd pay against market volatility. And then it's worked its way back down. And what I find interesting is over the past year, as the market has gone on a relentless climb higher, the VIX goes lower. You can't see that. The VIX goes lower. Okay? It's not quite to 10. Not quite. But it's under 20. And it seems to be moving right around that 18 mark. And right now it's 18. So I say to you this. I say, got a lot of cash out there. Not a lot of fear. And maybe because if stocks drop, you can always buy the dip. Now, I know it's funny. There was, by the way, just a penny stock conference in Reno. Or maybe it was Vegas. I think it was Reno. And they all got together, Zach Morris and Laid Back, and I think PJ Matlock, and I think Bugs Bunny went, and there was some dog and a golf cart, and a whole bunch of guys, right? And these are people that are pumping and promoting certain stocks that they invest in, and they make a lot of money. And they all get Rolexes, and they fly private jets because they're totally making money in the stock market. We see pictures of them, they look like they're about 25 years old. It's great. So they say buy the dip. And when they say buy the dip, I don't really listen, right? Because they're just for entertainment purposes. They're not investment advisors. But I look at the fear, the lack of fear, and my guess is when you've got $5.5 trillion in growth in cash, you can buy the dip. Why not, right? You like a stock. It went from $10 to $5, you buy a little. By the way, $5.5 trillion goes a long way to driving up marginal stock prices. We're not worried. That's what this chart tells me. As a society, we're not that worried about the stock market. We feel more in control than we ever did. And so, now we're going to get back to the index. Total value index. Now I see it. So now let's try to close this out. Stock market's worth about 25 trillion. Okay? We're up from 2,900 to 3,500. 29, 35 is 600. It's about 20%. So from 20 to 25 is 25%. So let's go with it. Okay? So stocks have gone up 20%, 25%. Money has gone up 20, 25%. Just saying. I bet you that if the Treasury and the Federal Reserve Bank try to restrict the money supply, and the way you're going to know that is you're going to watch M2, and you're going to watch velocity of money. And I want every day, I want you to be like looking at this. I want you to look at the CPI. I want you to look at the Consumer Price Index. When you see them clamping on the brakes and destroying cash, I gave you the charts, reserves. That's when you got to worry. That's when the VIX starts going up, right? When there's not enough money. So you can't buy the dip because as a society, they took the money away. Now here's the good part. The good part is we're at a debt ceiling. So for 2 months, they're going to have to pay down debt, which means pump cash. So maybe we bought 2 months, pump some cash. When they taper and they stop buying debt, that puts less money out in the system. But if they pay down debt, it puts money back in the system. So watch for taper, watch for any other moves. Like you might want to drive reserves up even higher. You might say, you know what? The growth of 2.2 trillion in reserves isn't enough. Give me another trillion. Well, that's a very fast way to restrict money supply. And so I guess what I'll say is this. Watch the money supply. Keep your eyes on it. It doesn't move that fast, right? But it'll give you a sense of the headwinds or the tailwinds that the stock market faces. Now, this is not Stock Tips 101. This is not telling you to buy low, sell high. This is just saying, I believe Jeffrey Cohen, on behalf of Chicago Quantum and U.S. Advanced Computing Infrastructures, Inc., we believe that the U.S. money supply and flow of cash and the production of reserves and the amount of debt matters with stock prices, and that you should think that it matters too. Wow. I think you would consider that investment advice. All right, let's keep going. We see a small cap plateau for many months now. Small caps went up a lot, right? But they've been flat. Small caps, Main Street has been flat for a very long time now. 3 months, 6 months, I'll show you a chart. So how do you play it? I mean, we're long small caps right now. I mean, I love it. I love the risk. I love the rush of a high beta stock with low volatility. High beta. I mean, the S&P 500 goes up. The Russell goes up. They do something where they pump up the stock market again. Wow. These small caps are going to just fly to the moon, right? But if we taper and we hurt our economy and COVID gets worse, stocks are in the toilet. No one's going to buy them. They're going to be a penny, right? So how do you earn income and build an exit strategy? Well, you can sell calls. Out of the money calls, which basically locks in a profit. You get some income and you keep it rolling. And so the other thing you could do is you could buy puts to hedge a decline. So you can either buy puts or you can sell calls. It's the same thing. One, you're paying for insurance. The other one, you're getting paid for insurance. I like it, but you're limiting your upside. So we're going to talk a little more about that in the coming weeks. We've been really thinking about this. So much to talk about in the markets, right? So what else did I see? I'm going to give you a little COVID love here. We'll talk about COVID. So COVID's winning, and that's not good news. So this is Illinois. Now, Illinois has been handling it pretty well. We've got a pretty aggressive governor. I've been watching it. So deaths are up. Deaths are up a lot in Illinois. And so I was wondering because, I mean, their cases are up. Kids are back in school. We hear about it every week. 3, 4, 5 new cases in our local school districts, right? a lot of cases, a lot of COVID, right? There's a lot of deaths. And so I'm wondering, where are they? Okay? What can I learn from this? And I look at the number of cases in Illinois. And the case count has actually fluctuated down a bit. New cases at 4,000, but 7-day average at 3,800. That's not a lot of growth. That's not a very steep curve. And so, good news is the cases aren't going up as fast. Deaths are. What's going on? Illinois is a microcosm of the United States. So I look at this chart, which was on the government website, the Illinois Department of Health. And what I see here is I see the size of the bubbles. Now, when you go downstate, these are small counties. These counties down here, they don't have a lot of people. Not a lot at all. Maybe you get on Joliet, right? So when you see big bubbles like this, basically that means like the whole town got it, right? These are the same size bubbles as Lake County. Not quite as big as Cook County, but Lake, McHenry, Will County, DuPage County. I mean, it's big numbers. Now you come close to St. Louis, yeah, you're going to have issues, right? But for the most part, this is a downstate issue. And I remember when COVID first came out, my wife Diana, who I love dearly, we went down to do some kayaking. We figured it was pretty safe. So we're walking through town. We figured just check it out. We ended up walking through a drive-through to get some food. You couldn't walk into the restaurants. People were mad at us. People were yelling at us and grimacing at us because we were wearing our masks. That's downstate for you. This is another map, COVID-19 map. And again, you look at the size of the bubbles. Size of the bubbles are a proxy for like penetration or number of people with COVID. These bubbles get pretty large when you go down south. Southern Illinois. So what we're seeing is COVID has hit the more rural parts of our state. And it's taken a toll. So that tells me a little more nuanced view of COVID. That's just interesting, right? So now there's the political side. God, I didn't think I was going to be talking this long. I got coding to do. So I got to tell you this. There's a lot going on here. There's a lot going on in the markets. I'm sorry if you like a short video. This is pretty darn long. But let me make this bigger. You got to see this stuff. It's crazy. They're trying to decide whether to spend an additional $3.5 trillion that we don't have. $3.5 trillion. Now, my guess is some of that would be great. Okay? But why don't you take the budget you have, which is like $2.5 trillion, and just spend it on the good things? Why would you spend an extra $3.5 trillion? I don't know. I can't imagine that they're going to build factories and roads and airports and bridges for $3.5 trillion. Because to be honest, we got plenty of money for that stuff now. Just build it. If the bridge needs repairing in near our neighborhood, they repair the bridge, right? You don't need to pump an extra $1 trillion into it. Now maybe you want to build some new bridges. Maybe you want to build some whatever. I don't know. But this isn't Dubai where we're going to build islands in the water. This is just money that's just going to be pumped into a system that has probably enough. And so, but they're going to spend $3.5 trillion at a time when we are coming up, banging our heads against a federal debt ceiling. That'll be pressing, binding, that potentially could destroy the faith and trust of the United States credit by October or November, according to Treasury Secretary Janet Yellen. So, yeah. I have a better idea. Why don't you spend $1 trillion less in the next 5 years and use that trillion to pay off some of the debt so that you can borrow when you need to? It's kind of like, again, I go back to the credit card, right? Here's my corporate credit card. I keep that because it's money to spend, right? So I got my corporate credit card here. If I'm up to the debt limit on my corporate credit card, the last thing I want to do is go out and buy a new stereo. I should probably pay some off in case I really need it, right? So I think this is just weird and silly, right? Why would you spend more at a time? Oh, the other thing, you can't find people to work. You got to pay hiring bonuses. Like I'm seeing job postings for my old jobs. These are well-paying jobs. I made a lot of money in the past. Oh my God. I can't believe I'm doing this. Do you know I make like $1 a month from my Medium articles, right? I could make so much money going back to the corporate world. And those jobs are now available, right? So we're in a time with 5.2% unemployment. We're basically at full employment. There's no one to work. There's COVID mandates. People don't even want to take the jobs because they got to get vaxxed. And now we're going to pump $3.5 trillion into the economy? What are you doing? What's the thinking process? It'd be different if unemployment was 10% and they bring their tin. I got a tin cup. They bring their tin cup, right, to the welfare people and say, please fill it with something to eat. I'm hungry. No one's doing that. There's full employment. No one wants to work. There's free money in the government. Free. I don't take it, but I probably could. On my $1 a month I get from my Medium post, I could probably get welfare right now, right? Because we're a startup. And everyone that works with me probably get welfare too. But we're investing in the future, right? So we're going to pump $3.5 trillion in. It's so ridiculous. I just can't take it anymore. I'm so sorry. I can't take it anymore. Now, what about the firm, Jeff? Talk a lot about business and the economy, but what about your business? So, why do we have a picture of a glacier? I'm going to talk to you about this, right? We have a picture of a glacier because that's the speed of the progress that we are making. Now, glaciers are immovable. They feel permanent, although they flow forward. We have had to recode large parts of our platform. Not the model, and not the logic to solve the model, although we are trying to accelerate that. We still have our goal from like 3 months ago, 3 hours or less to run our job. We're still at 5 or 6. But we've had some setbacks. In August, we took a vacation, things changed. And now we are spending considerable time and energy recoding. In fact, if you go to our website and you try to buy investment advisory services using our model, they're shut down. Those services are now unavailable while we're improving our code. Ton of coding. Okay, that's number one. Number two, we have begun advertising our video and our website again. Wow, I love it. So instead of having 25 views in my video every week, I got 35 views. It's awesome. I pay like 30 cents a view, and then on the other side, I could do a skip view. You know, when you're watching some other video and that annoying thing comes up on the bottom and you say skip real fast. Well, if you don't say skip real fast and you watch 15 seconds of a video, I pay you 3 cents. Wow. It's great. I think I'm doing like $7 a day. I just figured, you know what? Let's get some feedback on our stuff. Well, the feedback on our videos has been amazing. People are willing to click into our YouTube channel and look at it. We picked up a few subscribers. It was nice, right? And we learned that it's working. Our videos are working. We don't have a lot of eyes on them, but maybe the eyes that get on them like them. Now, for our website search, this has been very interesting. So we had a lot of success. I'll show you the page that we had success on early on. It's actually really cool. Our most successful page in the history of our website is negative beta stocks, which no one cares about because it's quantitative. Most people don't even know what beta is or how to calculate it. By the way, it is the covariance of a stock against another stock divided by the variance of the other stock. So it is like systematic risk. When that other stock is the S&P 500, it is the systematic risk in that business. So a beta of 2 means it's going to move twice as fast as the market. So if the S&P 500 is going to the moon and you got high beta stocks, you're going to the moon. So why would I want a negative beta? Well, why? And what is it and why do I care? So negative beta means when the S&P 500 goes in the toilet, you're going to go to the moon. It's the opposite. So when the S&P 500 goes up, you're probably going to go down. The other way to look at it is it's a meme stock. It's going to move. It moves not independent. It moves against the market. So what happens is people are betting on one stock. Like CEI, Canberra Energy, right now is memed. CEI is, I called this stock at like 63 cents. It dropped to 50 cents. I beat myself up over it. Well, now it's $1.50, right? Not because the model picked it, but because Laid Back and Zach Morris, who are fictional characters, picked it. So that gets it a negative beta because as the stock market is dropping or going up or staying the same, there's Canberra Energy to the moon, right? So some of those days are going to be against the S&P. You're going to have a negative beta. So what happens is we publish a list of the negative beta stocks and we talk about it. Well, the good news is this page gets top of the fold. If you know that old saying. So let's take a look at negative beta stocks. So
it's 12
Investopedia,
hours.
Market Beat, and Chicago Quantum. It's unbelievable. With a third search result, right? So that told me I can get people to my website for free just by having great content. So I decided to take my high yield stock page, pump it up. Income investors prefer stocks that pay a large dividend. You could be paid while you wait. Not a lot more words because I don't really know what to say. And then here's a list of the highest beta stocks from the past year. Okay, that's cool. You know, there was a stock that paid distributions of 47%. Dividends, distributions, return of capital, whatever. Another one 43%. Another one 38%, 36%. So imagine the stock goes up, but you're getting 36% on your money. Holy cannoli, Batman. That's a lot of money. And if they can keep doing this even for a year, you don't want 38% of your money back and the stock stays the same price. I love that, right? So we advertised this, and what Google came back with right away is, Jeff, the site is low quality, it's boring. This is a boring page. People look at it, they read the clever, oh, be paid while you wait, and they take a look at some of these stocks. By the way, there's no name of the company. It's not formatted very nice. You have to scroll to the bottom to even understand how we calculate it. So what we learned is advertise, spend like $20 getting people to the page, and then Google tells you what's wrong with your page. So we now learned that we got to improve our dividend page. It's cool though. Like if you like learning about stock market, why wouldn't you want to know all the high dividend stocks? Oh, and then the stock splits. That's another one. Jeff, tell me about stock splits. Well, here's all the splits. And a stock split is a corporate action where the company's board of directors and shareholders both vote to change the number of shares outstanding without changing the value of the company. All right. Awesome. People go. People are looking, right? This is something that people do. They're like, oh, Apple splits and it goes up. Maybe some other company splits and they go up. Tesla. I heard Tesla splits and it goes up. How about NVIDIA? So there's Tesla, there's Apple. How about NVIDIA? How about CSX, freight company? How about a bunch of oil and gas companies? EXPI, by the way, I think our model likes that one now. EXPI. Put that on your radar. That's probably going to go up. And then there's ones that have been reverse split. So when you see a quarter, it's a 4-to-1 reverse. So that means 4 shares get turned into 1 share at 4 times the price. You're going to see a lot of reverse stock splits. Now, people come in here and they look. I'm pretty sure they don't understand how to read the data, so they're not happy, right? So we're gonna have to do more explanation and all that. But this is good because we're driving a lot of movement, a lot of eyeballs to our site, and that's great. So good stuff. So we're always going to have to improve because social media management is a competency and it's pretty much an everyday job. So thank you, Google, for teaching us. And it's not that expensive to advertise, get some more eyeballs. So I want to just talk a little bit about our foray, our parlay into options trading. So we open up a margin account. We're doing it. It's great. So we bought some YOLO calls. Woo! YOLO the once, man. We're in, we're long, and we're buying more calls, right? We sold 80% of them for a profit because we bought when the stock was low. We bought the dip. And then when the stock went up, the options went up. It was nice. Probably made $1,000. It was great. We got a couple, though, maybe a couple $100 worth. Maybe it cost us 500, so there's 500 of our profit. September 17 calls that are probably going to expire worthless. So some we got out, some we didn't. We kind of kept that residual risk. It's the 10th now. We have a week. The odds of these things going up. The problem is that what we sell them for is our commission. So it'd be like selling them for free, for half a penny. I don't know, whatever. Let's try it out. So I wanted to talk a little bit before we get into it, though. I want to show you what's happening with the small caps, because I think it's important that you see it. By the way, we paid for Yahoo Finance Plus, so we have additional functionality and capability that we didn't have before. We're still trying it out. We're still learning. It's interesting. So this is 1 day over 1 year. So what this means is it's the stock for the day.
It is Friday, September 10th, 2021.
I didn't need to know that. Thank you, though. Take a look at that regression line. That regression line is flat. Let's draw it correctly. There it is. Nice and flat. Flat since February 2nd. So if you put money in the Russell, in small caps, just a whole index of small caps, you've been flat since February. Maybe it paid a little dividend, maybe it didn't. That's crazy. See, has it been up? Once. Twice. 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. It's been up 18 times, which means it's been down 18 times. So I guess if you're a swing trader, you love it. But I'm not. I like to buy and hold. So 18 times it went up and 18 times it went down, and I sweated every one of those times. And buying the dip now is just stupid because it didn't go up. So you bought the dip and now you're holding right about where you bought it. Buying the dip only works when things are going up. It doesn't work when things are flat. You just end up investing your life savings in some stock that you bought the dip. This is odd. I want you to realize how odd this is because let's go back. Let's go back 5 years. The last time we had a flat was 2019, February. Like the whole 2019, and then it went up and then it crashed. You gotta go back a long time for flat. Maximum. Small caps don't do flat. Yeah, 2006 we saw a flat period. Oh, look, it crashed afterwards. Small caps don't do flat. Flat's not good with small cap. You're expecting that the market's going to go up, that things are going to do better, that Main Street is going to bring back the good times. And in fact, what we're seeing is no. Flat. Flat is bad. I'm just telling you. So the Russell's flat, and our biotechs are flat, and I don't like it. I haven't liked it for a long time. This is what it is. But now I'm going to show you a contrast. So small caps are flat. What about large caps? Well, oh, hang on. What about the whole market? No, let's just go the spider. S&P 500. 500, largest, most valuable stocks. Well, this isn't... Well, first off, we're just a bunch of assholes because we didn't just buy the S&P. Look at that. This is a daily chart. Oh, weekly chart. Let's look at daily. I like daily. Daily chart is for the... How long? For the whole year. The whole year. The largest cap stocks have gone up straight for the whole year. So let's say you bought the dip here. Okay. Bought it at 329. And you bought some dip here. 350, 370, 380, 380, 390. Bought the dip at 410. Oh, you bought the dip at 414. You were really worried. Well, it's at 450. It's at 448.96. You bought a lot of dips. Sell today. That's money in the bank, baby. Profit for the whole year. I bet you if I go back 2 years, yeah, market crash because of COVID, went right back up again. So we have a dichotomy, we have a diversion, we have a difference, right? We have the small caps flat, we have the large caps up. And my guess is I could show you which large caps went up. I'm going to ask you a question. Was it John Deere? So this is, first off, I love this. Love this company, first off. FinViz, thank you for the data. Love them. What this chart is, just to explain, this is a daily chart of the S&P 500 for 1 day, today. Apple's down almost 3% today. That's why it's blood red. But Apple is worth more, because of the size of the rectangle, than the entire credit industry and part of the diversified insurance industry. Amazon is worth, looks like it's as much as the whole healthcare industry, this whole healthcare drug manufacturers. Google's worth more than drug manufacturers and probably diagnostics, maybe. Hard to tell, right? So here's what we're going to look at. We're going to go back a year. Okay? Google's up 85%. Apple's up 31%. Microsoft up 40%. What's interesting is Amazon's not. Amazon did okay, right? Tesla's up 106%. ExxonMobil's up 43%. Danaher, 63%. So what we've seen, some of these big companies, Nvidia's up. Look at a bubble chart. I can't do it for the year. I'm so sorry. That's only for 1 day. So I can do this for the year. So I'm trying to show you is, as long as you weren't in Vertex Pharmaceuticals. Oh, Biotech. Wait a minute, Jeffrey. Biotech, isn't that where you're invested? Yeah, that's the place not to be. And Clorox. Why would Clorox do badly? I thought Clorox would do great because of COVID. Newmont Mining. Newmont Corporation. I mean, there's just a couple of stocks. Amgen and Merck have not done well with the COVID, with the full year. Verizon and AT&T have not done well. So very few losers over the past year. Big winners. Nike's up 42%. American Tower Corp is up 18%. I mean, the largest companies in each industry are up. So maybe there's a lesson learned here. Big cap, big money. It just flows in passively. Small cap, active investment, requires thought, requires insight, requires analytics, not so passive. I mean, you could put money in it. I don't know anyone that puts money into small cap passive funds, right? So 6 months been tough, right? I just think we should talk about that. It's important. All right. What else did I lay out for you? All right. Well, Positions in the stocks. Just we're in a summer doldrums. There's no movement. There's no memeing. There's no anything. I mean, Akebia, we're waiting till March to get a federal decision on a new drug. Corbis, it's just early. It's early. There's no new drug that's right there, ready to go. And Satsuma, their competitor got approved with an open label safety study. Satsuma's doing like an intense phase 3, close, blind label, double blind, secret taste test, Coke versus Pepsi versus Stars and Stripes Cola. By the way, if you're cost conscious, drink Stars and Stripes Cola. Sold at Dollar Tree. $1 for 93 fluid ounces. Do you know that most people pay $1 for this? 17 ounces. So you have this, or you have this. So if you're cost conscious, drink Stars and Stripes Cola. And don't drink the expensive stuff. All right. And that's how I think about our stocks. Because no one is drinking the Kool-Aid or the Stars and Stripes Cola when it comes to Satsuma, Akebia, and Corbis. They are languishing without volume, without interest. Now the good news is, the bad news is it's like watching paint dry. Pretty low volatility. Tons of upside potential. I mean, these things have kurtosis. Like some people have halitosis. Let's take a look at those charts. So this is what the model likes, right? It likes potential without price risk. Now, unfortunately, the stocks have been going down, and that's just because of where we're at. But we look at Satsuma. Satsuma's been over the same ground for a year. For a year. Let's take a look at this. Daily chart for a year. It's the same damn ground. Up and down and up and down. But if you've got your retirement in this, especially if you dollar cost averaged, you're right about where you were. It goes up 4% today. I don't even care. It's just not even moving. I call this boring. Now it did fall a lot, so we're not gonna look at that though. We're gonna try to get it right into. It doesn't matter. 1 year, boom, flat as a pancake. Couple ups, couple downs, but in general it's pretty flat. But if their medicine works, it's gonna be everywhere. My neighbors. I got so many neighbors, and I talk to them about migraines. And you know what they say? Jeff, I suffer terribly from migraines. I sit in a dark room with headphones on because I can't take the pain. Imagine, and in 2 hours there's no more pain. What are you willing to pay? $50? Sure you are. $100? Sure you are. $200? Maybe. $300? Yeah, be pretty rich for that. $500, probably out of the ballpark. $100, no problem. These guys are going to make a fortune, right? Now let's look at Corbis. Corbis got a little crazy, right? It jumped up. I wasn't in Corbis at that time, but then it went to sleep, and then it went up again, then it came down. And so we got in right around the 2 to 250 mark, but we bought in real small. And so we've dollar cost average down. What's interesting about the stock is it moves, goes up, comes down, goes up, comes down. This one's more volatile. This one's riskier. This one is scary. The model liked it before. The model liked it when it dropped and it just languished, right? But once it started going up and coming down, you got more price volatility. And so it's pretty rough. The only good thing about the stock is it doesn't move a lot every day. And when it does, it goes up generally. The big candles are generally green. So it goes up fast. It drops slowly like a torture chamber dripping dripping water on your forehead. Every day it's down a penny. God, I hate that stock. And why am I in it? I don't even know. But I mean, I like it from a due diligence and what they do and what they believe in and what they're investing in and their cash position and all that's fine. Let's take a look at Akebia. Now, Akebia should be the runner. It should be the Chicago Bears. Just a winning team, right? And so what happened is we love the stock. I got to tell you, I love the stock, right? Look at it. Up and down and up and down and up and down. I mean, my guess is I should have been buying and selling the whole time, but I wasn't. I just bought and I held. So I missed the whole thing. Probably bought right around $3. Maybe it was here, 310, and I've been just all over the place. And so what happens with this stock is they had an at-the-money program, which means right here at $4, they started selling $100 million worth of stock. They rode that thing down to $2.50 a share. It's awful. From $4 to $2.50, and now you understand why investors have no patience for biotech, because they raised $100 million, but everyone who invested, and by the way, the company was worth like $600 million at that point. They took the price from $600 million to about $350 million. So they cost us $250 million to raise $100 million in their own pocket. I don't like that math. I never liked that math, right? And now it's trying to go back up again because there is good news. They're hiring a lot of people to sell to the nephrologists for kidney disease. They've got Orexia, which is used for the phosphate issue that people get with kidney disease. And now they're trying to get an iron thing going with vadadustat, and they're trying to get that approved. So now the nephrologists are going to love them. I'm covering your phosphate issue or phosphorus issue. I'm covering your iron issue. Next thing you know, maybe I'll sell some other drugs. I'll create a whole nephrology toolkit, right? Sounds good to me. But the thing can't hold a gain. And I think it's because people are afraid. People are afraid. Now, Kiwi's got a lot of good news in the due diligence, but people are afraid. And honestly, when I heard the CEO talk yesterday at the conference, he spoke at a conference. If you go to Akebia Investor Relations and you look for Morgan Stanley conference yesterday and you listen, CEO wasn't that Butler, his name. Wasn't that compelling. It's a good company. It's worth more than $3. I know it is. But I'm not sure when. Because they destroyed my trust. They took my money, and they didn't have to. They didn't have to. They could have done an offering or something. Right? Been on the table, been up front, right? I need to raise $100 million. I'll pay 120 or 110, and I'll go through the process fine. Instead, you cost me $250 million by doing it this way. So, and who knows? Some guy said on StockTwits that they could do it again. That they have another 50% more shares authorized, or 100% more on, so they could double the number of shares and sell them all day long. At least we'll know about it, but there's a lack of confidence. So what's going to make biotechs like these go up, whether it's Corbis, whether it's Akebia, charts all pretty much look the same, which is pretty interesting. You need volume. You need excitement. You need news. You need people thinking, wow, drugs. This is the place where I want to be. You don't want people thinking about, well, I listened to the CEO and he paused when he said this and it made me a little nervous. I'm reading in. I listened to the conference. I got nothing better to do. I'm listening to the conference. I went back and I read their prospectus that they used to sell the stock. They had another at-the-market prospectus. Let me guess. They sold at $5 and they took it down to $3. Right? But they withdrew that prospectus and they had this new prospectus for $100 million. And thankfully, they already sold the $100 million. So there's no at-the-money program. But this is what happens. You get time on your hands to start reading and then thinking about the cash flows and where the money's coming from and the stock price. And while we've been talking, the stock is down 2.5 cents. So, what else I got to talk about? All right, well, I better go back to making the code. So, as a reminder, we passed our Series 65 exam. A couple weeks ago, you saw the books. They worked. Okay, and we took the test online. You should take the practice test FINRA gives you online. Probably 5 of the 140 questions were from that practice exam. Probably studied 50, 60 hours. Learned a ton. Had a call with a client this week. 2 calls, actually. And wow, the words that were coming from my mouth were actually technically accurate now. It was great. And we plan on completing our process to become a registered investment advisor, an RIA in Illinois. We'll register through FINRA and through the SEC, but the good news is we do not have to register with the SEC. We can register with Illinois. But right now, the process is taking a backseat to our coding and our investments, but it will be done by the time we are required to be registered. And we are thinking about how to capitalize on our success for our Chicago Quantum Net Score model. I've got some ideas. If you have ideas, call me at this number. Here's the thing. I got a landline. It rings. I answer it. I'm a real person. I answer the phone. I have a landline. How many people can even say that anymore? And I'll answer your call. And we can talk business if you'd like. And just so you know, because most people don't know, if you go to Medium and you look at Chicago Quantum in Medium, by the way, no one's reading our stuff. I got 100 views, 98 views in 30 days. Why do I even bother, right? We posted the top 20 inefficient stocks, the dog stars, the stocks that we're going to drop. And we published it first on the day that the pick was effective. Who does that? I gave away 20 stock picks. Dog shit. Dog stocks are going to fall, right? Shorts. Short them. 58 people viewed it. Average person took 2.5 minutes to read it. I made 14 cents. First off, I want to thank all my readers for the 14 cents you made me. Okay? But the point is... Oh, there it is. If you would have shorted those 20 stocks versus shorting the S&P 500, you would have made an extra 17.55% return, absolute return, in 35 trading days. Annualized rate, that's like a 200% return or something crazy. It's crazy. I don't even want to think about it. I didn't do it. Because right now I don't short anything. I don't bet against the market. I love America and I love the market. But you know what? Investors could, right? Here's the model as of August 30 and August 2nd. And look at those stocks down 60%, 42%, 39, 37. This is when the S&P 500 actually went up 3.5%. We picked the dogs. Total dogs. We published some insights. So if you read this, call me. Jeff, I'd like to know. I just had a guy email me last night. Jeff, I've been thinking about it. I put some money together. I want to invest in your model. I want to invest in your picks. Give me a stock pick. So I said, call me on my home. That's probably who's calling me as I started the video. So just take a look at Chicago Quantum. It's at Chicago Quantum. And we're publishing our results. So if you want to talk, it takes 2.5 minutes to read the article. Pick up the phone and say, Jeff, holy shit, you know how to make money in the stock market. All right. Last but not least, we have not forgotten our roots in quantum computing. We've completed our personal research into the $5 billion spent in quantum information sciences, quantum computing, and quantum technologies, but we have not yet updated our Medium articles, our website content. That we're holding close hold. If you want to pay, love to have a conversation. I'll walk you through it all. It's $2.50 an hour, so you got to be willing to pay. It has to be worth something to you. Eventually, We're going to share it with our readers. We're going to share it with our viewers. I'm going to close with this thought. Nothing in this video is investment advice. You should always do your due diligence before you invest in securities. I wish you good luck in the markets, and I hope you enjoyed the video. This is Jeffrey Cohen. I was not paid to do this video, and I do not make money doing these videos. Not by YouTube, not by anybody. So, thank you very much. We did all the work ourselves. Bye-bye now.